Hi, I'm Nick from NCG English, and today we're going to have a look at financial vocabulary. 45 key terms split over 4 videos. Today is part 1. Let's get started. So, what you'll learn? You're going to learn financial statement terms, banking vocabulary, pension funds, tax vocabulary, and stock market and investment words. So I've noticed that many of my business English students have difficulties with financial vocabulary. So this guide is designed to help you overcome these difficulties. So I've compiled a list of 45 essential words and phrases to help you succeed. The terms are organized in a logical order and come with easy to remember definitions, example sentences and some synonyms. I've also included tips and insights from my own experience in finance. So, number 1, an enterprise. An enterprise is another term for a company, business or firm. In English, there are often multiple words that mean the same thing. So it's good to know several synonyms for the same term. For example, when he purchased the company, it was a highly profitable enterprise. Well, the enterprise value, EV, is a calculation of the total value of a business, firm or company. For instance, does the report give the EV for Apex Training Limited? Number 2. Gearing. Gearing measures how much money a company is borrowing from banks. High gearing means the company is borrowing a lot. Low gearing means it's borrowing little. And ungeared means the company is not borrowing at all. Gearing ratio is a calculation of this concept. For example, the firm has borrowed more money this year, so the report from analysts will show higher gearing than last year. Number 3, return on investment or return on capital employed. ROI, ROCE. ROI, return on investment, and ROCE, return on capital employed, are similar calculations that show how much profit a company is making compared to the cost of investment. These calculations are commonly used in stock market reports. For example, we didn't pay much for this company, but it made a huge profit this year. Our investors will be thrilled with the high return on investment. What great news! Number 4, net worth. Net worth represents the total value of all a business or a company's assets minus its liabilities. The bottom line of a balance sheet is often referred to as the net worth of the company. For example, the total assets of the company are £350,000 and the liabilities are £225,000, making the net worth £125,000. 5. Intangible assets. When a company has an asset that you can physically touch, such as a car or a machine, these assets are tangible, which means you can touch them. But sometimes assets exist which don't have a physical existence. We are going to have a look at 4 of these assets straight after this point. They are goodwill, patents, trademarks, and brand value. Sometimes it's just shortened to intangibles. For example, we paid £1 million for the business, but the cost of machinery, vehicles, and computers was only £100,000. The rest is made up of intangibles. Number 6, goodwill. Goodwill is an intangible asset that represents the value of a business which does not take the form of physical or tangible assets. For instance, a firm of estate agents which has only £100,000 of assets, such as computers and furniture, could be sold for £1 million. The £1 million value would be so high because the firm could be very profitable. The difference between the £1 million and the £100,000, which is £900,000, would be the goodwill in the transaction. For example, the goodwill showing in our financial statements is the difference between what we paid for the 3 companies we bought and the value of their tangible assets. Goodwill is a real asset for us because it represents the ability of those companies to make good profit. Goodwill has another meaning. It means friendly and helpful. Friendly and helpful feelings or attitudes. We call Christmas the season of goodwill. Number 7. Trademarks. Trademarks are intangible assets that serve as an identity for products, services, or companies. They can be names, phrases, logos, symbols, designs, or sounds, and are protected from imitation by competitors when registered with the government. For example, the iconic M-shaped arch of McDonald's is a globally recognized trademark and cannot be duplicated by competitors. Meanwhile, the football club Tottenham Hotspur, or the Spurs, is unable to sell merchandise featuring their manager, Jose Mourinho, due to a trademark dispute. The rights to use his name belong to the Chelsea Football Club, who had previously secured a long-term trademark on it. Number 8. Patents. Patents are intangible assets that provide the sole right to use, that is, to exclude anybody else. The sole right to use, make or sell an invention through a government-issued license. If a patent is granted, the applicant has the exclusive right to use their invention, either in one country or globally. For example, the company Dyson, known for its vacuum cleaners and hair dryers, has secured patents on many of its products to prevent other companies from copying them. One may also come across a pat pending or patent applied for notation on a product, indicating that the patent is pending approval by the government. Number 9. Brand value. Brand value is similar to goodwill. It's an intangible asset that represents the value of a company's reputation. Unlike goodwill, which can be acquired, companies tend to build their brand value over time. Apple, Volvo, and Burberry are examples of successful companies with strong brand values. These brands have loyal customers who associate their products with a set of values and high-quality expectations. For example, to maintain our brand value, it's essential that all our staff are polite to the public, as we don't want to damage our reputation. Kodak is a prime example of a once successful global brand that has since disappeared. In 1997, the company had a value of $31 billion and employed 145,000 people. But by 2012, its brand value had become worthless, leading to its downfall. Number 10. Gross profit percentage. The gross profit percentage measures a business or a company's profitability before considering its expenses. It allows for comparison between different companies selling similar products by calculating their gross profit percentages. If a company sells a product for £100 and that product costs it £75 to make or to buy it, then the gross profit is £25 and the gross profit percentage is 25%. For example, Our gross profit percentage is lower compared to our competitors as we source our products from the UK, which is more expensive than China, where our competitors source their products. However, we can boast that our products are locally made. Well, thank you so much for watching this video to the very end. If you're not yet subscribed to my channel and you're learning English, then you're missing out on a lot of free content. So hit the red subscribe button and like this video if you enjoyed the content. I'm looking forward to seeing you in part 2.